Joining me now for a closer look at what's playing itself out in that market scene is independent analyst Jimmy Moyaha. Jimmy, always a pleasure. Hello.
Hi, Nolutanda. It's nice to be here.
Thank you so much for joining us, Jimmy. Let's talk about the big things, I think, out there, certainly U.S. inflation. Keen to get your thoughts on this print. And really, Jimmy, what's proving to be stubborn inflation?
I don't know if it's stubborn inflation, because if I had a conversation with David Shapiro about this yesterday. We seem to, as a market and as investors, be very quick to forget the 2021 $2 trillion stimulus package that the United States put into the economy. That has to feel itself out and come out in the market in some way, shape or form. Yes, it has been 3 years, but did we suddenly think that we were just going to go back to a situation where that number didn't factor in anywhere? So I'm not too surprised that inflation continues to remain sticky. We saw the jobs numbers come out, 303,000 non-farms jobs created as opposed to the 200,000 that were expected to be created. We saw ADP numbers 2 days before that's coming in bang on target at 184,000. Unemployment back at 3.8%. But the US economy has shown for the last couple of months it is strong. And I think the markets as well have to take into account something else, is that we've been on this rhetoric for the longest time saying 2021, oh, this was going to be our year, we're going to rebound from COVID. We said the same thing in 2022, in 2023. We keep wanting to front run the market where we know that there are new factors at play that need to be taken into account. And that's from the side of investors, the side of traders, the side of institutions. From the side of central banks, they've come out very clearly to say, guys, we're going to wait and see. We're going to wait until the data comes out and we're going to make our decisions based on the data. The market then chooses to ignore what central bank governors are saying and says, oh, but we expect that the data will come in here, therefore we're going to make that decision on behalf of the data itself. So it's further evidence that we need to be waiting for the information to come through to confirm what we think. Yes, it's good and well to forecast, but there's a limit to forecasting. There's a limit to how far into the future you can expect something to happen. There's other factors along the way that will affect that and that will adjust that perspective. So 3.5%. We had already expected 3.4%, which was an increase from the 3.2 in the last reading. So we had expected an increase already. So the market has been able to forecast to that point. And to miss by 0.1% is also not the end of the world. To expect 3.4 to get 3.5 also does mean that whatever's been put in place from a policy perspective is working. It might not be working at the pace and the rate at which we want it to, but it is working.
I mean, I laughed a little bit there when you mentioned that stimulus package. I think they called President Joe Biden Money Check Joe at the time. That's how happy Americans were with that stimulus package. I think you make a very good point here. Jimmy, one of the main rules we should all know here is don't fight the Fed. Do you think that markets participants would possibly trying to pressurize the Fed here, and also maybe also trying to bring forward what might go wrong if interest rates aren't cut sooner? Because what we are contending with now is the fact that there'll possibly be no rate cuts in June. And of course, there's lots of doomsday scenarios that are now being painted about what that might mean.
Absolutely. We started the year expecting 7 rate cuts from the US Fed. We went down to 4, we went down to 3. Now we're hoping for 2, possibly even 1. And the Fed's message and the Fed's stance has been very, very clear. Fed Chair Jerome Powell said when this whole thing started in the pandemic, he's going to learn from the things that he saw unfold in the 2008 financial crisis, and he's going to make different decisions based on those learnings. Now, yes, it's a precarious position, because if we hold rates too long at certain levels, you might find yourself that you could trigger something like a recession. You could trigger a massive sell-off. It does have those sorts of effects there. But if you look at what the Fed is doing, the Fed has said that they're monitoring several data points and they're waiting for a confluence of those points on a sustained basis. At the moment, if you get choppy rate cuts here and there or choppy readings in data, then and we did this. We had inconsistent data points coming through around 2021, 2022-ish, and the Fed then took a decision to say, okay, we're going to start to look at points further out. And now you're seeing that the points that are coming in, the data points that are coming in, are very much in line with expectations. Now, just because we don't like those expectations doesn't necessarily mean that the market has to now have a knee-jerk reaction. I think the market has definitely been under a lot of pressure from a return perspective. There's been a sustained sort of lackluster return profile, and maybe market participants are thinking, you know what, we're tired, we're exhausted, let's just get on with it. But at the same time, the Fed chair has mentioned numerous occasions he's not going to be pressured to make decisions. And it brought up an interesting point as well. So yes, there's one side of it where you look at what could potentially happen if they don't cut. But the other side of it is as well, you're seeing other economies like Europe that are saying we're ready to cut. Maybe we should cut ahead of the Fed. And that decoupling from taking your cue from the US Fed is going to be a very telling narrative or a very telling decision-making process from central bank governors. Do you wait as the ECB? Do you wait as the SARB for the US because they've been front-running this inflation conversation? Or do you take into account your own economy and make decisions for your own economy independent of the Fed?
Well, this sounds like there's still a lot of monetary policy tensions to come, Jimmy. I want to bring it back home. I want to speak about We Buy Cars. I think it's an interesting one. It's a big news of the day here at home. We saw We Buy Cars listing, I think before we came on air, I checked that share price at around 20 Rand, 22 cents. I think it listed at 20 Rand. I'm keen to get your thoughts on this. And I think the big thing that stands out for me here is, you know, those who are investing in the share must also be aware that a big part of this listing is to then go and assist transaction capital. What might be seeing there at the parent level?
So the listing itself is a monumental pivot point for transaction capital, for shareholders, anyone that's been invested. I mean, if you think about the fact that TC yesterday was at around 10 Rand, we expected that 6 Rand, 10 cents or so of it would be a We Buy Cars, and you saw that in the market. When the We Buy Cars listing went through, transaction capital dropped down to 3 Rand 90, 3 Rand 80 or so. It does put investors in quite a unique situation in that you've now unbundled the profitable asset. You're still sitting on the transaction capital side with a concerning SA taxi business that is heavily indebted, that you now have to turn around some way, shape or form. There's no guarantee that'll happen. There's no guarantee that the market believes that it is worth investing in at this stage, given all the things that are unfolding around inflation and around the other macro factors. From a We Buy Cars perspective, we expected 18 Rand 75. That was the indicative price we got yesterday, leading up to today's listing. And coming in at 20 Rand, one could argue that, okay, it's coming in quite strong. I think market participants and investors are still going to look to see where to from here from a value perspective. Do you see it going north of 25 Rand? Do you see it going north of 30 Rand? What do the volumes look like? We know that they've been able to do really good volumes from a transaction point of view in terms of number of vehicles sold on a month-to-month basis. But at the same time, we've also seen there have been reports on a fairly consistent basis about people being unhappy with the cars, unsatisfied with the services or with the vehicles that they've procured there. So investor sentiment, consumer sentiment could be something else to look at there. From a company perspective, a market cap just shy of 8 billion Rand is an impressive figure nonetheless. It really is. And institutional investors might be looking at the business to say, look, there's a good asset as compared to what the asset looked like under the transaction capital stable, and therefore there might be a shift in capital allocation towards it.
We'll be watching that share price very properly, I guess, Jimmy. Let's look at some stocks that have found favor with your industry peers before we get into your stock pick.
I'm going for another AI stock, Salesforce, which is actually a Dow 30 company as well. Simply going to benefit, I think, looking for very, very good results in the second half of the year. Again, on AI spend, which I think we have underestimated. I don't think we understand. Even Jamie Dimon, in his letter out, earlier this week from JP Morgan, mentioned that this is like the steam engine. AI, it's just going to change everything that we do in business. And so Salesforce is a company that helps you. It's a software business that helps you with AI, introduce it into your businesses and so on. It's as I say, it's a Dow 30 company, but I just like it. It's kind of been ignored. Just catching up a bit now, so very solid business.
So my stock pick will be Anglo-Plat. Quite a bit of a contrarian view there. I think as much as the numbers that they released earlier this year were not that great, and they're also experiencing, I think, job cuts sometime this year. I do think as a long-term play, looking at the balance sheet and it being one of the biggest platinum producers and other different commodities as a whole, I do think that Anglo is where I'll probably be putting my cash into in the long term. So it's a long-term play.
I'm going to go for Billiton. So commodities kind of go in and out of favor. They've been out of favor for a while. I mean, the stock has been flat for the year. I think it's down 10% year to date. But it's coming back into fashion as we see. And here's the thing about commodities, especially commodities like iron ore and copper, we need them. So irrespective of whether the company is out of favor or not. Big mining companies are not really investing in new capacity. So we're going to need more of these commodities in the future, especially if this whole AI theme plays out. Now you've probably already got all of those AI stocks. So you start, and their prices are very, very high. So you need to start to look downstream as to the types of things that are actually going to facilitate the growth of this theme. And copper certainly is one of them. And then simply, if you can ignore all of that, you can just simply buy this company for its magnificent dividend yield and really good management. If you're going to buy a commodity company, you need to look at people who are really know how to manage a company and have got very good capital allocation. And to me, Billiton has got probably one of the best team of capital allocators in the world markets.
All right, Jimmy, keen to get your thoughts maybe on one or two of those. We don't have much time, but let's look at Salesforce, Amplats, and BHP.
Salesforce, good technology company, good software company there. I can see what David's looking at there. The share price has run from 250 to about 300 in the last 3 months. So from the start of January to now, it's run about $50 or 25% so far. If we're looking at Amplats, that is another decent pick from Sean in that respect. The share price has sort of bottomed out, and you can see that sort of picking out bottoms has been a very difficult thing to do. But if you look at the way platinum counters seem to be recovering from the huge sell-off that they went through. I mean, I think about things like Implats or Impala in the case where it ran from 59 Rand, we're sitting closer to just under 100 Rand here. It reminds me of share that I gave out was Sasol, saying that it would dip down to 130. It bounced off that almost to the number, went up to 170, sitting at about 166. So I can see what Sean is looking at there. BHP, dividend yield, can't fight that, can't argue that. Shareholders are looking for value at this point and are looking for returns in an environment where it might be difficult to find those.
With that said, which stock are you going with this afternoon?
It's always a difficult situation because there's always so many that look attractive at this point. I think about someone like ShopRite, where you might not get another chance other than the 240 Rand that we're at now. It has a strong support at 220 Rand as well. I'm looking at Mustech. It's also good dividend yield there. If I'm going to give a stock pick, I'll give out Baldwin, sitting quite down for the last couple of years. They're making a big move into restructuring some of the value adds that they add to their product offering. Still got a dividend yield north of 7% as well, so you might still be benefiting from that. It will be interesting to see how their numbers start to play out. They've got a lot of developments on the go, and the reality is, from a property perspective, it is going to be difficult to find really good property stocks, but residential property that Baldwin plays in makes for a good investment case if we are thinking about a couple of years from now.
Well, Jimmy, always a pleasure having you with us. Thank you so much for your time this afternoon. And that was your midday markets update with independent analyst Jimmy Moyaha.